two undervalued stocks to consider for a specific month. This is the video that I do every single month talking about two undervalued stocks. Now we're on October and I have really good undervalued stocks to talk about here in this video. These are not stocks that I talk about often. I think you guys are really going to enjoy them. One of them is a dividend stock. It's actually a REIT. I'm going to give you an update on REITs and what I've been doing over there. Many of you know that I'm bullish on this area of the market. And the other one is a dirt cheap stock that I believe has over 200% upside over the next 5 years. And I'm actually extremely excited to do this video because I'm finally starting to find opportunities. The market's coming down. This is what I've been waiting for. I've been having a cash position. I've been deploying my cash position. I've been finding amazing buying opportunities, a lot of deals, especially if you're looking outside the AI stocks and the Magnificent Seven. I mean, I'm very excited. I'm just so happy that I'm finally getting the opportunity to deploy some of the cash positions that I've been doing. I'm selling a lot of puts, dollar cost averaging in a lot of stocks, and even buying a lot of new stocks that I haven't really owned before. And in my last video, I talked about two stocks, was it in September? One of them was BJ's Wholesale Club. This one has performed amazingly well. The market went down, most stocks crashed a lot, and you had BJ's going up 13%. I mean, the stock was extremely undervalued. It's a mini Costco trading at 15 times earnings, while Costco is trading at 37 times earnings. It's the same exact business model. So I'm still extremely bullish on the company. The second one was Ulta Beauty. It's down 4.5% on the months. It hasn't played out, but it's still 1 month. I normally have, 2 to 5 year horizon with a lot of these stocks. So yeah, I still believe both of them are actually extremely undervalued, especially Ulta Beauty. Now to start this video, I'm gonna give you an update on REITs. Normally, I don't talk about my holdings on YouTube because I like to change my mind maybe tomorrow. I don't have to make a video every single day if I decide to change my mind, or if I find a better opportunity. I'm willing to sell a stock at a loss if I find a better opportunity, like Visa if it trades at 18 times earnings. So I don't have to be making videos every single day, which is why I have my own Discord, which if you're interested in joining, the link is in the description. But this is what I did with REITs. I started getting very bullish on REITs in 2023. I bought Avalon Bay Communities at $157 per share. I made around 23% on Avalon Bay Communities, and I sold it around 187 or 188. It was around a 23% gain. And then I noticed MAA, which is Mid-America Apartment Community, has been going down. So I started dollar cost averaging into this one. And the recent buy that I've been initiating, and this is what I'm going to disclose in this video, is actually O, which is Realty Income. And this is the first stock I'm going to talk about in this video. I think this company is safer than most companies, and it actually providing an amazing value proposition with an amazing dividend yield. I've been a fan of this company for a while, but I said I'm going to get extremely interested if Realty Income is actually trading above a 6% dividend yield, and now this is happening. Realty Income is trading above a 6% dividend yield, around a 6.1% dividend yield, one of the highest it has pretty much yielded in a while. You could see it here, it's around 6.6%. The company still increases the dividend. So I see an opportunity with Realty Income. And a lot of people are fearful of REITs, especially Realty Income, because they believe that we're going into a recession. A lot of leases might expire, and if the leases expire, maybe the retailers are not going to renew them and all that kind of stuff. Well, Realty Income actually doesn't have this problem because most of the leases are expiring after 2032. Around 49% of them are expiring after 2032. If we have a bad recession in 2024, only 3.6% of the leases are expiring in 2024. It's not a small amount, but it's not a huge amount. And if you look at the tenants that Realty Income actually has, Dollar General, yes, the stock has been struggling, but I mean, people still go to dollar stores. People still go to Walgreens to get prescriptions, or to go to Village MD, which is their primary care clinics within the Walgreens. People still go to 7-Eleven. People still go to Wynn Resorts. People still, do FedEx stuff, LA Fitness. People still work out. People still shop groceries at BJ's Wholesale Club. People still go to CVS and Sam's Club and Walmart. Maybe not to AMC or Regal. Maybe those are some kind of risk, but it's only 2.4% of the portfolio. Most of the portfolio is actually pretty safe, in my opinion. I think it will hold up well. I think most of those tenants are going to be paying their rent to Realty Income. I'm not very worried about it, so I think Realty Income is actually could do a lot better than most people believe going into some kind of a recession. It's also pretty big, one of the largest REITs that's trading in the stock market. If you look at their latest deal, which a lot of you asked me about, is the Bellagio. Most of you know the Bellagio property in Las Vegas. I mean, this is how it looks like with this amazing fountain and the water stuff. I mean, it's pretty amazing. It's an iconic property pretty much. And Realty Income actually bought, I believe, 21% of the entities that own it, so around 21%, and they got a yield of around 7.7% within common equity and preferred equity. Now, I believe 7.7% is an amazing return to own an iconic property like the Bellagio. That's just my opinion. But you have a lot of other people that were actually not happy with the deal, because if you look at the valuation that Realty Income actually paid, the cap rate is only 5.2%, which is sometimes lower than the cost of capital. So 5.2%, it's not the highest cap rate in the world. I've seen a lot of articles on Seeking Alpha. A lot of people are complaining about the 5.2% cap rate, that they actually overpaid for the property. Now, I personally believe they haven't overpaid for the property. The Bellagio is an amazing, iconic trophy asset that now Realty Income actually owns, and it's very different from the other ones. It has over a 26-year remaining 26-year lease, and when the 26 expired, I'm sure MGM and whoever is in the Bellagio, they're going to be renewing the property. The property is not going anywhere. This is an amazing property with very long-term leases that I believe is going to ultimately give Realty Income a multiple expansion in the future, kind of like VC properties. I know I made a video, I said VC, all of you made fun of me, which is fine. VC or VC, that doesn't matter to me. But I still believe it's ultimately going to get a multiple expansion. They have done a deal before with Boston Harbor for Wynn Resorts. They bought the property and they leased it to Wynn Resorts. It has been working out amazingly well. And people also doubted this deal, which is why I still believe that the Bellagio is actually a good one. And if you look at other triple nets, if you just go browse on any kind of triple net properties, you look at what's for sale in the United States. This is something like a Dollar General. I mean, just a trash store in a trash location in Illinois, in a town I've never heard of, as the cap rate is 6.6%. This is another one in Texas, 5.8%. The highest cap rate on a Dollar General store with something like a 6-year remaining lease is 7% cap rate to around 6%. So if it's a 6% cap rate for a Dollar General in a crazy location, do you really want me to believe that Realty Income overpaid for the Bellagio in Las Vegas at 5.2% with a 26-year lease? I personally don't think so. I think it was a good deal. It might not look like a good deal right now, but it's going to eventually look like a good deal in the future. This is an amazing, iconic property. And the best part about it is they were actually able to, secure a much lower interest rate, because there was a loan, in place whenever they actually bought it, and they took over the loan. Is 6.2 years, around 3.6% interest, fixed all-in interest. So it's pretty amazing. They're not going to be able to pay it off in 6 years, most likely not. But still, 3.6% interest in this high environment, and they're getting 5.2% cap rate. I personally believe Realty Income did not overpay. I think the deal makes a lot of sense. I'm excited if it continues making such deals in the future. The company is big enough. They can do a lot of such deals, get more exposure, more diversification, especially to longer-term leases, which is ultimately going to give Realty Income a multiple expansion, maybe where VC is actually trading at. Now, if we look at where Realty Income is trading at, it's trading at 12 times FFO per share. 12 times is the March 2020 multiple for this company. It's one of the lowest since the 2008 financial crisis. In 2008, whenever we had the housing stuff, Realty Income bottomed at 8 times FFO. Now it's sitting at 12 times FFO, which is not far from what it was trading at the 2008-2009 financial crisis bottom. This is how bad the sentiment is around REITs. It's not just Realty Income, it's a lot of them. Also, Agree Realty, an amazing company, has been crashing. Other apartment REITs, high-quality office REITs, a lot of them are just crashing like it's the end of the world. Look where Realty Income is trading at. It's been pretty crazy. I talked about the share dilution and many other things, which is why I'm not going to repeat myself in the video. But I noticed a lot of people have been looking at Realty Income, and they look at websites like Yahoo Finance, and it shows that the payout ratio is 226%. So they think that the dividend is going to be cut because it's 226%. I personally believe the dividend is safe. You mainly have to look at the the cash from operation, and you have to take off the common dividend pays. And the common dividend pays are 1.8 billion. Cash from operations are 2.5 billion. Realty income is not going to cut the dividend. I mean, I'm pretty sure of that. Unless you have maybe like half of their tenants default or anything crazy. It's likely not never going to happen because of the quality of the tenants that this company actually has. But again, I believe, the dividend is safe. It's not a 226% payout ratio. It's something like a 72% payout ratio, which is not bad at all. Now, the biggest risk with this company is the balance sheet. Their balance sheet is not bad. It's locked in at pretty low interest rates, in my opinion. Most of it is fixed interest rate stuff, which is not bad at all. I think 2024 they might have to dilute a little bit of stock to pay down the debt because they have 1.8 billion maturing. Now, even after Realty Income pays the dividend, they might have like 700 million left, so they would still need 1.1 billion to pay it off. So I think they're going to have to dilute some stock in 2024. 2025 is manageable. 2026, there's no way in the world that Realty Income is going to be able to pay it off without either diluting stock or maybe selling some assets or maybe trying to push it off to a later date. But I personally believe from now till 2026, the interest rate environment should have changed. Maybe they can refinance it at a lower, rate. But I'm just focusing for now over the next 2 years. I think Realty Income is pretty safe until we get to 2026. I mean, the management have a lot of experience. I'm sure they can do something about it. So I still believe Realty Income presents an amazing buying opportunity. I see something like a 6% dividend yield. I see around 3 to 4% AFFO growth per share, which would give me around a 10 to 11% return just from this alone, without including a multiple expansion whenever you have a bottom and hopefully in treasury rates very, very soon, and then you have the tide starting to shift, or you have interest rates coming down maybe next year or the year after. I mean, I see a massive multiple expansion potential. Now it's sitting at 12 times AFFO. The lowest it has traded at was 8 times. The highest was 24 times, and the mean is 17.5 times. So there's more upside than downside, in my opinion, with Realty Income at such prices. But the stock could keep going down, which is what I'm doing in my portfolio. Is I buy a small position and a dollar cost average on the way down above a 6% dividend yield. So I pretty much started buying it last week. I think around $51 or something around the 6% dividend. I was $51.70 or $51.80. This is when I started buying Realty Income. And I believe it's presenting an amazing opportunity. It might keep going down, but this is why you need a plan in place to buy a dollar cost average. So this was my first one, which is more of a dividend stock. The second one is extremely, extremely undervalued. In my personal opinion, I'm going to talk about it right now. I have to actually pull up the chart. And this is Sand, which is Sandstorm Gold. Sandstorm Gold, I talked about this company before, but I have a lot of new subscribers. A lot of things have changed. Sandstorm Gold is trading at the same multiple it was trading at in 2014, or the same price it was trading at in 2014. Now, Sandstorm Gold is a royalty company, meaning you have companies like Barrick Gold, Newmont, and many others, even copper companies, silver mining companies. They are mining on the lands of Sandstorm Gold. Sometimes they get financing from Sandstorm, but they mostly mine on the land, which means these companies are putting in all the capex, they're putting everything to mine the gold, and they are paying Sandstorm royalties, which gives Sandstorm a much higher margin than the miners. It gives it much more safety because their cost per ounce is like $300 or $350. I mean, it's something insane, very high margins. They are net taking on inflationary risk. If the risk or if the cost to mine the gold increases in the future, Sandstorm cost is not going to increase because the miners are facing the cost, not the royalty company, which is actually Sandstorm. Now, Sandstorm has a pretty interesting story. But before I get in the story, now it's over a 49% gold exposure, 21% silver, 20% copper, and you have other metals which are around 10%. They are trying to get to 73% gold and just split out the portfolio a little bit. Now, because of everything I told you about the royalty business, they have much higher margins, much safer. They normally trade at much higher multiples than just a typical gold miner. So you have something like WPM, which is Wheaton Precious Metals, is sitting at 32.5 times free cash flow. You have Franco-Nevada, the most popular one, is sitting at 30 times free cash flow. And you have Sandstorm trading at 11 times free cash flow. And the actual multiple right now on $1,800 an ounce of gold for the 2023 production is around 9 times free cash flow for Sandstorm. It's much, much cheaper than FNV in WPM, much, much cheaper. And this is for very good reasons, but the company is diversified. They have over 235 royalty assets all around the world. It's not just some companies that's stuck in some kind of a jurisdiction like in Africa or Zimbabwe or something. They have a lot of United States properties, a lot of trophy properties in Turkey and all around the world. Pretty amazing stuff for something like Sandstorm, yet it trades much, much cheaper than the other ones. And this is mainly from the management. The management is the worst thing about this company, but it has been improving. It's still the same manager. His name is Nolan Watson. And Nolan Watson pretty much destroys the company over the last 5 years. This is the way it seems like, because if you look at the shares outstanding, I mean, it was around 94 million in 2013. Now it's 234 million. If you look at the free cash flow of the company, it's way up. But if you look at free cash flow per share, it's pretty much the same it was in 2013 or 2014. So they were not focused on per share metrics. They diluted a lot of stocks to grow and do a lot of acquisitions. And this has freaked out the market. But what has freaked out the market the most was the latest dilution that they made in 2022. This is what pretty much killed the stock. This is what killed Sandstorm. Now, a lot of companies do issue shares to do acquisitions, but the CEO, Nolan Watson, actually did not notify shareholders that he's planning to do an equity raise. And they did an interview with him. They told him, why don't you communicate better with shareholders? Why haven't you told shareholders beforehand that you plan on doing an equity raise? And he answered them, and he just basically said that his mentor years ago, when he was mentoring him, he taught him to surprise investors with an equity raise, because if you surprise them, they're not going to know beforehand. Because if they know beforehand, they might sell the stock and the stock will go down. So you will get less money if you raise equity. And investors did not like that at all. They were selling left and right. Everyone was selling Sandstorm. No one wanted to be part of it. But the acquisitions are pretty amazing. I have to admit, pretty amazing stuff. Now, since then, the CEO is communicating better. You could see on his page, there's some kind of a shareholder fax where he answers the frequently asked questions. He communicates a lot with shareholders, do a lot of live streams, a lot of calls, trying to be more transparent. He promised investors, he promised everyone that there will be no more share dilution, no more. He's just going to focus on paying down the debt over the next few years. The assets are going to grow by themselves. They're going to eventually reach around 165, 175 million, over 135,000 ounces of gold on peak production. This is because a lot of the assets are still developing. They are still building the mines. They are not yet producing gold and silver, which is why the assets are going to grow Sandstorm without Sandstorm having to dilute stock or issue any shares or do anything crazy, which is why I personally believe that if the market just believes Nolan, if Nolan sticks straight for pretty much 2 years or maybe 3 years or even 1 year, if the market just sees Sandstorm more of a traditional, boring royalty company that collects the royalties, pays the dividend, does some buybacks, do some acquisitions once in a while, pay down the debt, discipline. No more share dilution, no more surprises. This is what Nolan said. Now, if he stick to his word over the next pretty much 1 to 2 years, the stock should at least be trading, in my opinion, around 20 to 22 times free cash flow, which would still be much lower than Franco-Nevada at 31 times. So if Sandstorm just doubles on, gets a multiple re-rating, gets a multiple normalization, and the market has a little bit more confidence in the CEO, and Sandstorm goes back to 20 times free cash flow, this is more than 100% on the upside, in my opinion, over the next 2 to 3 years for something like Sandstorm without actually wanting or without actually needing the price of gold to go up. Now, if the price of gold goes up, this assumption, 160 million of free cash flow, now the company is at 1.4 billion, which is around the 9-time multiple. This is assuming $1,800 an ounce. Now, if gold is trading at $2,000 an ounce or $2,200 an ounce, you could look at the production numbers and, 125,000 production. You could, take a look at a lot of the stuff and the cost per ounce. I personally believe we could get something close to a 3x on Sandstorm over the next 5 years. But what I'm personally counting on is just a multiple expansion with Sandstorm. I don't need gold to go up. Gold can stay the same. All I want is Nolan to stick to his word and take the free cash flow, pay down the debt, reduce interest expense, try to just better the portfolio, pay the dividend, do buybacks once in a while, just have some discipline. This is what he said. He said no more share dilution, no more equity raises, no more surprises. Gonna be boring over the next few years because the assets are gonna grow Sandstorm without Sandstorm actually needing to grow. So this is how I think about it. I think it's more of a short-term pain story for long-term gain. The short-term pain was in 2022 whenever he did over $1 billion of acquisitions. Now those acquisitions are going to take care of Sandstorm growth over the next few years without Sandstorm having to do anything. So I see a massive margin of safety with Sandstorm. This is a pretty tradable stock. I've been in and out of it many times. I talked about it a little bit before on YouTube, but I personally believe it's extremely undervalued at $4.73, trading at 9 times free cash flow, which is pretty much cheaper than a lot of gold miners. This is a royalty company trading like a gold miner. I mean, to me, it's a pretty amazing value proposition. I think it's extremely undervalued. I hope Nolan sticks to his word. I personally believe he learned his lesson. He will most likely do that. But these were my 2 undervalued stocks to consider for this month. I really hope you enjoyed this video. If you did, please press the like button. It was not financial advice again, and maybe consider subscribing. So I hope to see you in another video.